Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. We're going to see if we can come up now with a silver lining to the gold story with our ETF research director, Nina Mishra. And you say you've brought that silver lining to us. Performance last year for gold, not so good, but things are looking up now this year.
Yeah, not so good would be kind. They had a terrible performance last year. The gold prices tumbled about 28% after 12 years of straight bull run. And among the reasons were pickup in the US economy, start of taper, and no inflation. Gold is considered as an inflation hedge, and why it had been going for the past so many years, one of the reasons was that there was this anticipation of higher inflation in future because of the easy money policies all over the world.
Yeah.
But that did not happen in the developed world. Inflation still remains very low. So gold prices tumbled last year, but they are recovering nicely. And gold miners, which are like leverage plays on the price of the metals, they had even greater pains last year. Some of them lost more than 50-60% of their value. And of course, they are also rebounding strongly this year.
So what's behind the resurgence?
One of the main reasons is the rising concern about the strength of the economic recovery. You see that the recent economic data has been mixed to soft.
Right.
So investors are concerned whether we are going back to that muddle through 2% growth rate again after a very strong, rather strong 3% plus growth in the second half of last year. Then there was great pickup in demand in China. Chinese consumption rose 41% last year. And it is reported that the Chinese central bank also bought a lot of gold for their reserves, taking advantage of the low prices. And of course, yesterday's Janet Yellen's testimony about the continuation of the easy monetary policies also led to a surge in gold and gold miners' prices yesterday. Gold, in fact, touched its 3 months high yesterday.
Yep.
So can the surge continue? It depends upon the direction of the monetary policy. If the US dollar continues to be strong and if interest rates again start rising, then that is bad for gold. But if interest rates kind of stay at the current levels and go up very gradually and the Chinese demand continues to pick up, then this rally can continue. And another thing I would like to add that the demand in India has been going down. Last year it was down mainly because gold contributes to this rising current account deficit over there. So the government, after the emerging market crisis and currency plunge last year, the government introduced a lot of import curbs on gold. And gold prices are very high in India, so the demand in India is going down. And China has now taken over India as the largest consumer of this precious metal in the world.
Very interesting.
Yeah.
And the yesterday that you referred to was February the 11th, so people have a point of reference who are watching. All right, so bottom line, you can't count out gold yet, and you've got some examples of how people can incorporate gold exposure into their portfolio, right?
Yeah, I believe in having a small exposure to gold in their portfolio just as a long-term inflation hedge and as a portfolio diversifier as well.
Okay.
And here on this chart, actually, I have the comparative performance of gold and gold miners compared to S&P 500. So you can see that S&P 500 was rather lackluster this year over the past 1 month. Gold prices picked up, but gold miners really surged. And the junior gold miners fund, which focuses on smaller and micro cap companies, that really led the surge.
I thought maybe they were just the gold miners in training or something.
Yeah, junior is an interesting name. So on the first slide, I have the Spider Gold ETF.
Yep.
The ticker is GLD, and it is the most popular gold ETF. It holds physical gold in its walls and tracks the prices of the metal. Charges 40 basis points in expenses, up more than 6% this year. And this ETF, in fact, lost a lot of assets last year because of the plunge in prices, but it still manages more than 30 billion in assets.
Okay, and then you've got the Market Vectors gold mining ETF, right?
Yeah, it is the most popular gold mining ETF. The ticker is GDX. A little bit concentrated in top holdings, top 3 holdings, Gold Corp, New Corp, and Barrick Gold. They account for about 30% of assets. It charges 52 basis points in expenses. It's up more than 17–18% this year.
Okay, and then there's those junior miners again.
Yeah, junior miners, they suffered a lot of pain last year, and they are surging this year. This is the second most popular mining ETF in the gold mining space. The ticker is GDXJ. It has 68 companies in its baskets. As I mentioned, mostly small and micro cap gold miners. Charges 55 basis points in expenses. It's surged this year up more than 27% this year.
And you know, I have to ask, do you own any of these?
Yes, I do. I own GLD.
Oh, okay, great. Well, thank you for that information. And if you would like more information on ETFs in general, more ETF commentary, all you have to do is go to Zacks.com if you're not there already, and link to the ETF section of our website. With Nina, I'm Terry Ruffalo.